Hi everyone, and welcome to a quick chat. Today we have with us Youssef from Assomption Life. Welcome, Youssef.
Thank you, Maria. Hey, Debbie.
Hi. Yeah. So Youssef with Assomption Life is going to talk to us about mortgage insurance. Mm-hmm. We know that Assomption Life is a carrier which specializes in insurance as well as investments. But what we want to do today is we want to specifically talk about mortgage insurance and the difference between taking your own plan as opposed to taking a plan through your lender.
Yeah, absolutely, Mary. Actually, there are quite many differences. Mm-hmm. So let's start with the first one. The first one will be around the premiums. The premiums at the banks usually are not guaranteed. And the other thing is that they are based on the group insurance risk, which means that younger clients will have to pay for the risk of older ones. Mm-hmm. The one with the individual life insurance contract is based on your own risk. Okay. So they are qualifying you throughout a whole, and what we call an underwriting process, where they are asking multiple medical and non-medical questions, and you qualify for it. Mm-hmm. So that's the first thing. The second thing will be about what we call the transferability of the contract. What does it mean? It means that you own your own contract with you when you go with an individual life insurance, compared to a group or a bank insurance, where actually the bank is the owner, which means that they also choose who are the beneficiaries, who are themselves.
Right.
So let's say there is a death, and actually the clients, not the client, but the beneficiaries claim for that. Mm-hmm. The bank will pay itself. With an individual life insurance contract, actually the owner will choose their own beneficiaries. Okay. The other thing will be around the fact also that today, let's say you went with a bank like BMO because they got you the best interest rates, but 5 years from now you want to switch to another bank because you have better interest rates. Yes. If you go with a lender mortgage insurance, this means that you will have to qualify again because you lose your first insurance. With an individual life insurance, you are the owner, you keep it with you, and it will follow you no matter where you go.
Exactly. No matter where.
Absolutely.
The smarter choice.
Yeah.
Absolutely.
Yeah, I think so. So I have one last question. Mm-hmm. In terms of premiums. Mm-hmm. Comparing them to what the lender premiums are and an individual plan, mm-hmm. Is it very comparable?
Absolutely not. Actually, most of the time, the individual life insurance contracts are from 15 to 50% cheaper. Wow. Because they are based really on individual risk compared to a group risk. Okay. And the other thing is that the premiums are actually leveled and guaranteed mm-hmm. with the individual life contract, and they are not with the lender's actually contract. That's very important to consider. So all this together, cheaper premiums, actually the flexibility of choosing who are the beneficiaries, the flexibility of what we want to do with the amounts at the moment of claims, the fact that it's transferable if you're going from bank to another, yes. All this together, and there are actually multiple other major point that makes an individual life insurance on a mortgage side much better than the one from the lenders.
Yes.
That's amazing.
Exactly, especially now with the mortgage rates.
Yes.
Absolutely.
So if the client gets an opportunity to save a little,
absolutely,
works out great.
Yeah.
Thank you so much, Youssef.
You're very welcome.
Thank you all for joining us. Hope you enjoyed it, and see you next time.
Stay safe, everyone. Bye-bye.
Thank you. Bye-bye.